Hello everyone, I hope it's working. So my name is Victor, I have the honor to be moderator of this panel, and I founded Rockaway X. I see so many friends also in the audience, so it's good to see that it's bull market again, and this conference is sold out actually. I was just discussing with organizers, 1,700 visitors, and mostly institutions. So today we'll discuss how can we actually generate yield by staking assets, us as institutions. And let me welcome my fellow panelists. Please introduce yourself from one side to another.
Awesome. Happy to get us started. My name is Mara Schmid. I'm the CEO and co-founder at Alluvial. We're the software development company. There we go. Behind the Liquid Collective, a protocol that's focused on enabling enterprises and institutions to access staking in an easy-to-use manner.
Cool. Hello. Yeah. My name is Adrian. I'm one of the co-founders of a company called Stakehouse Financial. We're a boutique consulting firm that specializes in bringing traditional finance to decentralized finance. And we contribute to Lido, which is the largest staking pool or protocol or software, let's say, on the market. And the reason we contribute to Lido is because we believe that it's the best solution for all market participants, and in particular institutions. And so I'm happy to go into detail about why that's the case.
Thank you.
Hey, my name is Brian Crane. So I've been sort of involved in staking for a long time. I was CEO of Tendermint in 2017. So the company I started like Cosmos Network, and then started Course One around 6 years ago. And yeah, we're run staking infrastructure for around a bit over 50 different networks, have something close to 4 billion stake with us, and work with a lot of VC funds, custodians, exchanges, all kinds of entities. And yeah, happy to be here.
Yeah, my name is, can you hear me well? Yeah, good?
Yeah.
Good? Perfect. Laszlo Sebo, co-founder and CEO of Kiln. And Kiln, we are one of the leading rewards, digital asset reward platform. Staking is the majority of our business. We have 7.5 billion crypto assets that are $7.5 billion crypto assets that are staked under our technology, and working also with custodians, wallets, exchanges. Very happy to be here.
Yeah. Thanks a lot, guys, for the introduction. So we have some massive players here. We have, Lido. What is the assets under management of Lido now?
It's almost 10 million staked Ether.
Yeah.
So that's around $40 billion.
$40 billion.
In dollars it varies a bit.
Okay, but that's just AUM. So first I want to talk about how big is this market? So, Bitcoin mining, I just looked at some numbers this morning. It's around $17-20 billion, depending on what is the price you take per year in terms of revenue for miners. So let's talk about the staking market size. Laszlo, what's your view, roughly?
Yeah, I mean, I think we have approximately $340 billion crypto assets that are staked. So I don't know, if you take like 5% rewards, in average, maybe like 17-20 billion. That's how big is the market. And the market is getting bigger, right? Because you have new products coming to the market, like EigenLayer. Definitely, we're going to talk about it.
Yeah.
You were comparing mining and staking, but now there's Bitcoin staking coming. So I'm pretty.
We'll get to this.
Just pretty confident that that will pass by far. The staking market will pass by far the mining market in the future.
Okay.
So the halving coming.
The halving coming as well. Yeah.
And so Mara, Alluvium, you are only focused on Ethereum, yeah?
We're only focused on Ethereum. Today we support Ethereum-based layer staking. Of course, we're excited to diversify to support customers and restaking and other innovations that I think we're going to be talking about. I think on the market size perspective, Laszlo is completely right. I think we have seen a lot of consistent growth in the market. Interestingly enough, staking rates are probably one of the most consistently growing aspects of the market through market cycles that have been pretty uncorrelated, which has been interesting.
Okay. So still on the market. So, as we said, is as big as Bitcoin mining, like around $17 to $20 billion yearly revenue. And how many staking providers are there? I looked at this morning at stakingrewards.com. There is around 70 staking providers, but of course, like top 30 who are taking most of the market share. How about the chains? Like which chains are currently, we talked about Ethereum, but which other chains are currently mostly staked? And where do you see, the institutional demand also coming from in the next gen of institutional staking?
Yeah, I mean, obviously Ethereum is by far the largest. I think Solana is the second, and then wide range, Avalanche, Cosmos, Celestia, etc., Sui, Aptos. I mean, today, right, practically all. I think I did this looking through the other day, and you have like half of the market is Bitcoin, of the crypto market, but then of the rest, the vast majority, I think maybe something like 90% is either proof of stake assets or assets that are basically secured by proof of stake chains, right? Like even if you take the USDT or USDC, it's mostly issued on proof of stake chains. So it's basically, I mean, so almost half of the crypto market is
that's right.
proof of stake asset or secured by proof of stake chains.
Like there are hundreds of proof of stake chains that you can actually stake, but again, it's like top 10 that generate like 90% of the revenue. Let's be clear, yeah. So, so for us, like institutional staking providers, we need to make sure we are in the right assets. Is Cardano still a thing? Was it ever a thing?
Yeah. Who you asking the question?
Yeah.
I don't know.
I'm going to talk about the new ones. But Cardano, I mean, it's definitely one of the staking protocol that is very mature. If you look like a number of assets that are staked on Cardano, Ethereum, you still have what, maybe 5% that are being staked, even if the foundation is pushing not to pass 30%. You still have a lot of the market that is not staked still. And yeah, we're seeing a lot of demand for the new protocols. So for example, the Cosmos ecosystem that we discussed earlier, Dimension and Zeta Chain, Barrett Chain, these are the stakeable assets that are highly demanded by clients through custodians and exchanges. And we definitely, as a staking company, need to support them quite fast for our clients.
Yeah, okay, understand. Now, as you mentioned, like not all chains are staked differently. So Solana, for example, have 65% of SOL that is staked. This is the result also of then the price action currently, because there is so much demand on Solana, but actually on the supply side 65% of SOL is staked versus, for example, Ethereum, where 30% of it is staked, and actually a bit less, I think 25% of it is staked, and out of that 30% on Ethereum. So what would be your recommendation for the audience here, institutional investors? What are the solutions for them to stake their, ETH or Solana? Is it exchanges? Is it custodians? Of course, your solutions. What is like the area of potential solutions?
If I can take this and maybe take a step back for a second for members of the audience who are maybe not so in the inside baseball like we are, you have to ask the question of like, why do you want to stake in the first place? Why do you want to participate in crypto at all? And I think the simple reason is, so one of the first things to retain is that staking is not, we talk about yield and this and that, but it's not really a financial activity. So staking is a computer science process that helps secure a blockchain and ensure that it's credibly neutral, that it's secure, and so forth. And so staking is a way of expanding the rate at which these operations, these computer science operations, can take place. And I can only speak for Ethereum. For Cosmos, I'm only familiar with bad kids, and that's just about the extent of it. When it comes to something like Ethereum, the process of staking is exactly the same. So we talk a lot about institutional staking and so forth, or the next generation of institutional staking. But in reality, in my view, there is no next generation, and there's no current generation either. There's just staking, and period. And within that realm, how you decide to allocate your ETH to stake is very important for maintaining some of these economic values, which make Ethereum such an important settlement layer. And what we've seen, and the reason why within, let's say, the institutional market segment, why Lido is the leader at the moment, it has 10 million staked Ether. These are coming from institutions, from allocators, from individuals, and so forth, is that the best or the optimal risk-adjusted performance comes from diversification. And when you have Lido, which is very focused and very specialized on being software that aims to be easy staking for the user side and to promote a state of sort of competition on the node operator side, you create an outcome that's beneficial for all of the parties involved, including like obviously like Chorus One, Kiln, who are node operators within Lido, so sort of Lido on top of that.
Okay.
Yeah, so my headline would be to simply choose the best solution out there for your needs, and it's very likely that that will be Lido or ideally a decentralized liquid staking solution.
Mara is smiling, so what's your point of view?
Not a financial advice.
I think maybe one perspective that is helpful is just looking at the evolution of the market without being necessarily too opinionated about the products that are in it. Ethereum staking went live in December 2020, direct staking model, so basically operators that run and deploy their own infrastructure, and then participants who participated in staking as a service company. So this is very similar to running, a pre-deployed server effectively that you delegate to, were the two predominant staking models that existed in the market. Incredible because we were very successful in bootstrapping participation on Ethereum, even early days when, the risk relative to, the reward was still pretty high. Over time, what became clear with Ethereum in particular was there was a long period of time where you couldn't actually withdraw your principal from the network. So if you were an institution, you didn't really touch this product at all because the risk was outsized relative to the return. Over time, products like Lido, Rocket Pool that were pretty early to this second generation evolution of products looked at how do we, mitigate this sort of trade-off between, having your ETH staked on the network and being able to mobilize my staked capital or having that efficiency in the market. And so liquid staking tokens, which are basically on-chain receipts for a staked position, were a product that evolved pretty prominently through 2021, 2022, and 2023, today actually being the predominant form in which people participate in staking, period. I think that's quite an intuitive movement in the market. If you really think about it, with the commodity space, for example, people don't really move, commodities from one warehouse to another when they, execute trade finance transactions or other things. They actually trade, receipts or title of ownership, title of documents that are quite similar to the on-chain receipt products that, some of these solutions present. I think the risk-adjusted consideration that you raised is really interesting because staking inherently does carry certain risks, slashing risks being one of the predominant ones, and in Ethereum particularly a risk that is associated with the centralizational correlation factors that you might have with your infrastructure setup. So having diversified operators, having really robust infrastructure policies, these things are really important. And staking pools like the ones that Kiln develops, and then liquid staking products like ours that is more institutional and Lido, we really focus on diversifying that risk and supporting principal protection.
Okay, so we have kind of retail focused liquid staking. We have institutional liquid staking. How about Brian, Chorus One? Why should people stake on?
If I can just finish. I disagree with the characterization of retail focus versus institutional focus because it doesn't add up to the market reality, which is that everyone has adopted these liquid staking tokens progressively and over time. And it's not a case of there is one box for one and one for the other.
Okay.
Part of the value of crypto technology is this ability to be highly secure sort of for every participant in the space, which is what we are seeing play out as a market dynamic.
Okay. Do you have the split kind of Lido approximately of institutional? What is the percentage of the staked ETH held by institutions versus retail, depending how you
as it's sort of neutral software, it's very difficult to tell in reality, but you can see this very clearly by simply looking at the distribution of the staked ETH holders. And we know anecdotally from speaking to custodians and allocators that this ranges from individual holders holding half an ETH all the way to allocators holding hundreds of thousands of staked ETH on whatever, Anchorage, Copper, you name it. Yeah. So it's really quite a broad dispersion, and it's part of why it sort of appeals to such a broad audience.
Okay, understand. Brian, why should people stake on Chorus One?
Yeah, I mean, of course, it depends. So first of all, let's say if you take the Ethereum example, right? I mean, I think on Ethereum there's a variety of different things. So either one can have sort of dedicated staking with us, right? Where you say okay, someone spins up, some number of nodes, We also do have like pooled staking, right, which has advantages in the sense like, you can stake any amount, there's automatic compounding of rewards. One area where we have put a lot of work in is the area of MEV. So of course MEV basically means that if a validator produces a block, they have some ability to determine like the order of transaction, and there's value in that. And of course Flashbots had a massive success in developing a software that basically all of the Ethereum stake practically runs, which creates an auction to sort of sell the order of the transaction to the highest bidder. And today a significant part of the staking revenues on Ethereum comes from that. And then we have a sort of quant research team that's been focusing a lot on how do we optimize that. And we've also published a bunch of papers on that and run sort of a modified Ethereum client that optimizes staking rewards. And I think I was checking before whether, because of course it always varies a little bit the return difference, but for example in the last month we had on our nodes on Ethereum we had like 4.46% APR, and we sort of benchmarked this against the main institutional providers where the average was like 3.87.
Okay.
So there's like a very meaningful difference in staking
80
rewards
basis
there.
points. Okay.
So that's definitely one thing, but of course there's other things like, we are very deep also on the research side and on ventures, so often we work with VC funds or others who really value also the insights in terms of where are things going, what's happening, what are new protocols, and I think that's something where we add a lot of value for a lot of our partners.
Share information, yeah? Okay.
Yeah.
Laszlo, for you?
I mean, performance, it's still a very big piece doing MEV. So yes, as Chris was mentioning, we usually overperform the network by 5 to 10%. Our clients are looking at APR. If they have higher rewards for their customers are going to be happy. Security, anti-slashing policies, insurance on slashing, this is something that is quite key to minimize the risk of the staking product. And then accessibility, right? So if you are, I don't know, with Scale, for example, you can stake from a wallet, Trust Wallet or Ledger, any amounts. You're a retail person, you can stake from 5 blocks in one click. If you're an institution with native staking, and you can also launch liquid staking options if you're an exchange and you want to launch your own liquid staking token, or you want to you're an institution and an ETF. That's the demand we had quite a lot. You want to use liquid staking, but you don't want to funds. So we tokenize the validator. That's a product that we launched recently. So yeah, I mean there's various ways. Performance, security, accessibility are the main components for a staking company to be used.
Of course, high yield. Yeah. So I looked at the numbers this morning. What was it on ultrasound.money? You can see the Ethereum yield. It's around 5%, 3% base yield, 1% tips, 1% MEV, and so yeah. Solana is a bit different. Solana is right now, I think 6% yield. Combined with MEV, MEV is 0.6 of the 6, so it's 10%, so a bit less MEV. But I like the fact where these new products are coming in. Basically, what do you think will be the future of institutional staking? Will it be like more chains, or will it be more sources of yield? Where do you see the future? Maybe Mara, well, for you it's just Ethereum, yeah. So there is also a discussion about will reduction of the base yield going to be implemented? So how do you think about the futures of yield?
So I think probably from just a call it enterprise perspective, not just institutional allocators, I think a lot of business models today are still multi-chain. So if you're an exchange or a custodian, I think over the last few years we've seen a lot of those businesses focus on supporting multiple different networks and scaling, sort of horizontally. I think we're reaching an interesting point in time now, particularly on Ethereum, because one, we're seeing a ton of transaction volume scaling to L2. So a lot of that isn't happening on L1 anymore, and there's reason to believe that that trend is going to continue. And we're starting to see new solutions that change the structure of the security module on Ethereum, and restaking is probably the most prominent, example of that. So rehypothecating or reusing ETH as a security structure to support protocols that live, or borrow that security on top of it. So I think with that, and probably as an indicator of the maturation of the industry, we're probably going to start seeing a lot more products building new solutions on top of these yields. So, traditional staking products that are integrated into a broader range of experiences, structured products, we already have approved staked ETPs in jurisdictions like Canada. We're starting to see those in jurisdictions like Switzerland. It's probable that eventually we'll have them in the US, right? And interesting new models and product capabilities that will internalize some of these new protocol innovations like restaking. So for us, it's obviously very interesting. Our business model is B2B, and so we focus on enabling custodians and exchanges and asset managers to offer great solutions. And so it's been really exciting to see a lot of these new products.
How about this product we discussed offline, which was long LSD, short on ETH, and you get the delta? Is this also an interesting product for institutions?
We see hedge funds asking for this more, which is, I would say, generally a newer segment to think about staking as a trading strategy, because previously staking was something that you were entering a position into, and then who knows when you would get out. It could take weeks, could take a month, because Ethereum has dynamic entry and exit queues. Liquid staking, the solution that we spoke about earlier, offers this receipt structure where you can effectively trade in and out of your position semi-instantaneously. And so for hedge funds, it's interesting because it's the first time that they can get access to delta neutral strategies, by going, long an LST and short on ETH and effectively accruing the delta. And that wasn't previously possible. So again, it's interesting to see that the market is evolving with these new products, and this infrastructure is becoming a useful tool.
Interesting. So the panel next door is on derivatives, but we just actually touched on derivatives as well. So Laszlo, any ideas, like what's your perspective on the future of yield? How about ETF, Ethereum ETF? I know you have a view.
Yeah, I mean that's two different topics, right? I cannot agree more with Mara when she says that a lot of the transaction volume are going to L2s. And it's most probably that the Ethereum staking rewards will go down, inflation initiations will go down. So, opportunities like EigenLayer that are powering the validation engine for L2s, or just like sequencer staking or prover staking that we were discussing before, is also an opportunity for our clients to have higher rewards. Then on the ETP, ETF side of things, yes, there's staked ETP that we're seeing emerging. Most of the ETF in major jurisdiction won't be able at first to give back the staking rewards to the end user. So it will be a great business model for sure. And it might, even decrease the fees, have zero fees, let's hope. And it's a big market for us because they will do native staking, they will do liquid staking, sometimes commingling, sometimes not. They will use multiple providers. What we heard is that they're going to use multiple liquid staking solutions as well, because they don't want to put all of their eggs in the same baskets. So exciting markets, massive market is coming.
Okay. Brian, you spoke about MEV. How about EigenLayer? Are you also focused there?
Yeah, no, we've been doing a lot of work on EigenLayer, so we've integrated it in our staking products. So if you go to Chorus One, you can stake ETH and you can put it into EigenLayer. And I mean, on a high level, right? So if you're staking, then this capital is locked up, and of course there's some risk in that something could be slashed. But if you look at the history of proof of stake, the amount of funds that has been slashed is very tiny. And in many networks, some don't even have slashing, like Solana doesn't have slashing. Or let's say if you take like the Cosmos Hub, then the most that is slashable is 5% of the amount at stake. So it really means that the vast majority of capital, it's locked up, it's earning some rewards, but it's not actually subject to any risk. So of course, it does make a lot of sense to say, okay, you're going to take that capital and use that economic security to secure, additional services and earn additional returns. And we see that in the Cosmos ecosystem. There is like Cosmos Hub already has that, where there's some other chains that are also secured by the Cosmos Hub and by Atom. And in Ethereum, of course, we have EigenLayer now, where what's live is that people can put money ETH into EigenLayer, but it's not actually securing anything else. So people basically expect airdrops, but of course that's going to change, right? And so I do think we will see that a lot of the staked assets are used to secure, a wide variety of protocols, and then also means maybe you will not just earn ETH, but you will also earn other tokens. You certainly add more risk here. So I think it's something where, I think institutional audience is probably, in many cases, going to wait, right? And it's more the sort of crypto native VC funds that engage in this. But in the longer term, as this becomes more proven and more secure, I think this is also going to be very relevant for all the institutional.
But in the end, institutions also want yield. So EigenLayer, at least our calculations are, is going to add 3% on top of the Ethereum yield. So from let's say 5% to 8% starts getting interesting. So how is Lido, Adrian, thinking about EigenLayer?
I'd be curious after the panel to hear how you came to that estimate, actually. Because so this concept of restaking. So to answer your question, I think for now, anyway, the answer is that Lido is a small, thin, specialized software, and is likely going to stay that way. I don't know what the DAO may decide in the future or not, but regardless, it's a liquid staking router, let's say, between two sides of the marketplace. With regards to restaking, there's a layer of, I know earlier I said it's not a financial activity, but if you indulge me for a second, and you go on risk from, let's say, a banknote to US government debt to corporate debt to, you have a similar ladder with restaking, where you start with ETH, followed by staked ETH in any form, followed by restaked ETH, let alone all of the N varieties. So I think there's an open question for me left still, because Ethereum is such a valuable security layer, and because it's so expensive actually to run and attack, it's very valuable as a settlement layer. And there are a number of issues that remain to be clarified. I'm sure the EigenLayer team and others will solve this, but one of them is adverse selection. So if there's a service that can't afford security of its own at the level of Ethereum, it's natural that they would be attracted to try and rent it from Ethereum. And it's not clear to me that on a risk-adjusted basis, it would work out quite that way. So yes, institutions chase yield, sure, but always on a risk-adjusted basis. You can invest in meme coins for higher yield. This is not the point.
Okay, but institutions are not there about speculation. They're there because of yield and long-term sustainability, and of course, measured risk. Which brings me to Mara, because I know we are very much risk-oriented, and you have all different kinds of initiatives to prevent risk. So can you tell us, what is today holding institutions from leveraging even more institutional staking solutions?
So I think there's the risk aspect, and then there's the, consideration of available products and the regulatory backdrop that's probably relevant. I think one thing that we've spent a lot of time focusing on, Ethereum is quite unique. Brian just talked a little bit about how different protocols have different mechanisms that they use to enforce security. Ethereum is quite unique in the fact that it actually punishes centralization. So the more centralized you are and you have a breach potentially at the client level or at the server level or in your geography, you sort of have an exponential growth of the penalties that you incur. And so the network's actually encouraging everyone to be as decentralized as possible, which in the long run also means that the network is going to be more resilient, more stable, and generally provide a higher degree of security. So in terms of how we focus on this, we partner with a range of different operators. All our operators run multi-cloud, multi-region, multi-client infrastructure. There's been a tremendous amount of effort in the industry put together on, making a concerted effort to bring more execution layer clients into the fold, and everyone here is like doing their job to support that. And then from our perspective, one of the things that we really realize is there's no really standardized way to look at risk at all in the industry. I think performance is more easily measurable, more objective to measure. We have things like APR, or one of the things we look at is objective validator effectiveness. But when you look at risk, it becomes a lot harder. Like, what is a risky setup? What is a not risky setup? What is degree of diversification is good? What degree of diversification introduces latency? So we've developed different working groups with a lot of institutional and enterprise partners to start, breaking down the different tiers. I know Lido has a similar initiative with Goose. And so I think those things are really important because it levels everyone's understanding of how to actually calculate a just risk-adjusted rate or a risk-adjusted perspective. We don't really have that in the market today.
Yeah.
So I think that's one of the focus areas for us. And then of course there's a lot of other things that need to be resolved, particularly.
Well, as a VC, we think about it the same way. We say, we don't want to be slashed if we give our soul to someone or Ethereum. We want to have a very easy reporting. Like, we don't want to, treat with different CVS files. We want to make sure we are not paying like huge amounts of taxes, like VAT, if jurisdiction is somewhere. In order we want to be regulatory compliant. So, Laszlo, how about your view on risks and barriers to entry? Why we don't have more institutions staking today?
Yeah, I mean, you mentioned, what Mara said. Completely agree. You need to spread the stake if you can with multiple great providers that are enterprise grade that take security measures very seriously. So we manage validation keys. Sometimes there's smart contracts. In-house, we're building an internal security team, but we also doing like 3 audits a year. We have bug bounties on our tech. We have continuous smart contract monitoring. So we use 5 or 6 different solutions, and it's not like this and or this. It's actually this and this and this and this. And security is a big budget. This second part is the data piece that you mentioned. You are, as a VC, staking yourself, maybe 15 to 20 protocols. How complicated that is to get staking data reconciliation on these 15 to 20 chains, assuming that the reward is coming every block. This is really complex.
Well, we have a team to do that. It's like extremely complex. Right? Yeah.
So we have a full suite of API that is validator agnostic on the 20 main proof of stake protocols, so that you don't have to do it yourself. But this is much harder sometimes than just running the node itself.
Yeah. Reporting and accounting is like we completely underestimated initially.
Yeah,
Everyone
that's right.
Yeah.
Crazy. And even frankly, it's a barriers to entry even for us. Like we are the first user of our product, and we're improving the product by the day, I can tell you. Then another barrier to entry is also like just education, explaining what staking is, explaining what restaking is, explaining the risk of like one and the other, completely different. When you have smart contract, of course you had a risk, but you also had benefits to it. That's why I see it. I'm very much more optimistic about. When I read the question before, I was like, okay, barriers to entry. I don't see that many still.
Okay.
We're getting there. We're getting to like institutional adoption. We're getting to mass adoption of staking.
Adrian, you want to say something?
Yeah, I was going to say the characterization of barriers to entry is not real, because there are no actual barriers to entry. So institutions are staking today. They're using centralized providers. They're using decentralized liquid staking protocols, what have you. It's more of an education gap.
Okay.
And this just takes concerted effort to close, in particular for institutions that are not in crypto at all. So you're talking about like Eigenlayer and all of these like third-degree derivative things that might take decades. But the first step would be to educate the industry accordingly to help them understand what the benefits are of staking in the first place, beyond just a sort of financial reward.
Okay.
and get them into because the barriers to entry are actually quite nil, right? It's a very simple transaction. Like, yes, it might be more complicated to execute for somebody with like many signatures or a sign-off or an approval here and there, but people are able to, like, the proof is in the pudding.
And Brian, you wanted to say something?
Yeah, I mean, I think barrier to entry on a sort of token holder side, I mean, if you hold an asset anyway, and if you can stake it, and if you can earn, I don't know, 3, 5, 10% a year, like, it's a sort of no-brainer, right? And like, you want to do it. Often where there's a little bit of a challenge is that people use some kind of custody solution, and then there has to be like an integration in the custody solution. So, we work with many of the main custodians, and as do others. I think on the side of the staking providers, I think the barrier to entry is going up a lot. One is just, okay, you probably want to support lots of different protocols, and then you require a large team. Then you have things like the security side, whether you do things like ISO certification, things like insurance, right? This is difficult to do if you just sort of get in, right? You need a substantial team. The rewards data that Laszlo mentioned, it's a big effort, right? So we have a big effort on that as well, right? To get this accurate data across all the chains and be able to supply it and do this reporting. So it's hard, it's a lot of work. So I think, of course, we still have new entrants coming into the staking industry, and there's a lot of different staking companies, but I think the number of staking companies that are able to do it sort of to the level of standard that, institutional companies expect, that's actually not such a large number, that's like 5-ish companies, who are able to do that, and I think that's, with time, it's only getting harder.
Yeah, so there is consolidation coming into this space, And I would also say, like, maybe also in closing thoughts, like, if each of you could say like one sentence, what we should do to have more institutional dollars coming into our space. For me, it's, it's already a large industry, as large as Bitcoin mining, but becoming larger. Number one. Number two, Mara, I really liked your idea of basically using derivatives to have market neutral yield. Anything else, Laszlo? What is your vision for the future?
Bitcoin staking.
Bitcoin staking, okay.
So we can bypass the mining industry for good.
Yeah.
It's better than a joke. It's very hard to find rewards in the Bitcoin ecosystem right now. Often our clients have 2 to 3 times the AUM in Bitcoin than they have in Ethereum, and they don't trust centralized institution in the crypto ecosystem that is still maturing, I would say, since FTX. So they don't get rewards out of their Bitcoin or offer to the users.
Bitcoin staking, understand, Brian?
Yes.
Just briefly regarding the size of the industry, I think you're right that Bitcoin is maybe something like 20-30 billion a year in the mining rewards. Of course, that all goes to the miners. In staking, let's say staking rewards, I think it also is about right, something like 18, maybe 20 billion. But of course, the, let's say, average rewards on that, or average amount that goes to the operators of this infrastructure might be around 5%, let's say.
Yeah, we didn't talk about the fees.
So then you're talking about basically like 1 billion, that sort of, the staking industry.
Yeah.
So it's still actually way smaller than Bitcoin mining. When I was looking at it the other day, I was kind of amazed actually still how massive Bitcoin mining is in comparison. But I do think in the future this is, that is going to change and it's going to flip. And of course there's also, L2s, right, it's a big topic. But then with layer 2s too, you have, generally they're centralized today. They have like one sequencer that basically produces all the blocks, but they're also all working on decentralizing that to basically go to have, several different parties that do that. And then when you have several parties, or maybe you open it up, staking will also come towards roll-ups and L2s.
Yeah.
And so I think the whole...
So roll-ups, okay, cool.
Yeah.
Adrian, future for you?
I hope the momentum continues, right? I think there is a lot of very good momentum in the industry, and I hope it just continues to accelerate. And as for guidance to the future, I think sort of what Brian is alluding to is the importance of specialization and fighting the urge to come in and try and vertically integrate everything, because crypto has a very ruthless way of disintermediating, of commoditizing. But it doesn't necessarily mean that the margins can go to 5% in like node operation, but it doesn't mean they go to zero. It just means that the value chain specializes.
Yeah.
And so I think institutions that are able to focus on that specialization on customer relationship or structured products and to use building blocks from elsewhere.
Okay, so specialization. And Mara, for you, the future?
I think this is already pretty impressive. The fact that we have so many different products that are there to enable platforms. I think builders in the space, it's our responsibility to build really robust, really great solutions and support, partners in their policy dialogue and make sure that we educate on the considerations, the risks, the benefits of using this technology and supporting it.
So the policies. Okay, understand. Thank you so much, and thank you, the audience, for your attention.